Hey everyone, welcome back to Corporate Decoder, the place where we decode the not-so-secret secrets of the corporate world. Today we're diving into a report from the Federal Home Loan Bank of Atlanta, and let's just say it involves some serious money moving around, which is always fun to track. Make sure you're subscribed for more of these straightforward financial breakdowns. And if you want to chat about these filings live, we've got a Discord community linked in the description below. Come join us. So the Federal Home Loan Bank of Atlanta, or FHLB Atlanta as they're often called, is basically a big player in the financial world, helping out other banks. They get their money mainly by selling what they call consolidated obligations in the markets. Think of these as big loans they take out, and they're backed by all 11 federal home loan banks together. These borrowings are super important for them to operate and lend money. This report is detailing some of these financial obligations, specifically new ones or changes. It's like a check-in on how much money they're borrowing and from whom. This filing is all about informing investors and the public about these loans, which is a pretty standard but critical part of keeping things transparent. Now let's get to the juicy part, the actual numbers. This Schedule A is where all the action is. It lists out the consolidated obligation bonds and discount notes that FHLB Atlanta has committed to issue. These are essentially new debts they are taking on or have agreed to take on with specific dates and amounts. Take a look here. On July 9th, there's a bond with a settlement date of July 25th and it matures in July of 2027. This is a fixed rate bond, meaning the interest rate stays the same throughout its life. It's for a massive $10 million. What's interesting here is the optional principal redemption with a Bermudan call style. This means they might be able to pay it back early on certain dates before the official maturity. This can be a smart move for them if interest rates drop, allowing them to refinance at a lower cost. And here's another one, also on July 9th with a CQZP number 3130B72D5. This one matures in April of 2026 and it's a variable single index floater. These are a bit different. The interest they pay isn't fixed. It changes based on a specific financial index. This means if that index goes up, their interest payments go up, and if it goes down, their payments go down. This particular one is for a huge $550 million and it's categorized as non-pars, meaning they can't pay it back early. Big sums like this are critical to understand for the bank's financial health. Moving on to July 10th, we see another significant issuance. This CQ's IP 313-130B73A0 bond settles on July 11th and matures in October of the same year. It's also a variable single index floater, but this time for a staggering $1 billion. Again, no calling this one early. Large short-term variable rate debt like this can be sensitive to market interest rate fluctuations. If rates rise quickly, the cost of borrowing for this chunk of money spikes up. Looking back at the fixed rate issuance, like the one with the 4.625% coupon, these are more predictable. The bank knows exactly how much interest it needs to pay and when. This level of certainty is valuable, especially when managing a large portfolio of assets and liabilities. Here's another fixed rate bond, this one for $50 million, maturing in July of 2027 with a coupon rate of 4.3%. It also has an optional principal redemption with a Bermudan call style, indicating flexibility in managing this debt. You'll notice a lot of entries with NRCN for coupon percentage. This is common for variable rate instruments where the rate isn't fixed at issuance. The actual rate will be determined by the underlying index at specific points in time. This optional principal redemption is a key feature we see across several of these issuances. It gives the bank the power to call back the debt, meaning they can repay the principal amount before the actual maturity date. They can do this on predetermined call dates. This is a powerful tool for managing their overall cost of funds. If market rates fall significantly, they can redeem these higher cost bonds and issue new ones at a lower rate. The Bermudan call style is a bit more restrictive than American style, where they can call it any time. With Bermudan, they can only call it on specific recurring dates. It's a middle ground offering some flexibility without being completely open-ended. The fixed constant rate type simply means the interest rate is fixed and doesn't change over the life of the bond. It provides a stable and predictable interest expense for the bank. On the flip side, these variable single index floater type of bonds are more dynamic. Their interest rate moves with a specified index. This means their interest expense can go up or down, making financial planning a bit like navigating a river with shifting currents. Now, looking at this report and the types of debt FHLB Atlanta is issuing, it paints a picture of a bank actively managing its funding. They are raising substantial amounts of money, both short-term and long-term, and using a mix of fixed and variable rate instruments. This strategy allows them to capture potential cost savings when rates fall, but it also exposes them to the risk of rising interest expenses when rates go up, particularly with those variable rate floaters. The sheer scale of these issuances with billions of dollars in play highlights the importance of their operations in the broader financial system. From my read, FHLB Atlanta is a well-established institution with a clear strategy for funding its operations. The use of flexible call features and variable rates suggests they are trying to optimize their borrowing costs in a dynamic interest rate environment. However, the significant exposure to variable rates, like those billion-dollar floaters, means they are sensitive to Federal Reserve policy changes and overall market interest rate movements. A key risk for them would be a sudden sharp increase in interest rates, which would substantially increase their cost of funds, potentially squeezing their margins or requiring them to pass those costs on. On the other hand, if rates remain stable or decline, their strategy could prove very rewarding. The ability to issue such large sums of money also speaks to their creditworthiness and their role as a critical intermediary in the financial markets. Alright, that's our breakdown of the Federal Home Loan Bank of Atlanta's latest filing. What's your take on these numbers and what they signal for the company's future? Do you think their flexible borrowing strategy is a wise move? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.